The latter half of 2016's first quarter saw a fierce rally in world equity markets, and this was led by commodities such as oil and iron ore. But does this mean that we have escaped the dreadful clutches of a bear market? Joining us to discuss the outlook for emerging markets is Lesiba Mothata, Chief Economist at Investment Solutions, and Petri Redelinghuys, trader at Inkunzi Investments. Gentlemen, thanks for joining us. Let's start with you, Lesiba. Central banks certainly in focus this week. Bank of Japan, US Federal Reserve. What were the key takeaways for you? What did we need to learn and draw from those speeches?
It was interesting that the Bank of Japan disappointed. In fact, the equity markets have fallen more than 3% as a result. They've disappointed because the market is expecting more QE. They had said that they're looking at the impact of negative interest rates that it will have in the Japanese economy, which is struggling in terms of just output, GDP growth. And that just suggests that, you know what, one doubts if central banks really do have the magic wand, whether they do have the actual levers to turn the actual real economic activity around if they were to do that. But on the other side, at the Fed, we've seen that they're talking about keeping rates unchanged, although there's hints. When you read the actual statement, it talks about there's an improvement in economic activity. If you look at the beige book, it actually summarizes that regional economic activity is stronger. The household looks much better, which imply that we could begin to even see interest rates come up in June. It's much later than what the market were expecting. In fact, the market was seeing 100 basis points for the year, and now we're talking about the whole 50 basis points being taken out as a result, but some tightening is likely to be expressed before the year ends.
So, Lesiba, are you thinking June is what you... Let's say you said the markets were expecting a bit more. Let's find out what Petri is expecting. Fed hike, June, are you in the same boat? And implications for us?
Yeah, I think Lesiba's right. I think, you know, we heard a lot of talk from the Fed saying that they're going to hike 4 times this year. And you know, they've now reduced that to only 2 expected hikes for the year. 1 we've already seen. So, yeah, my question is indicating, well, rate hikes is indicative of a very strong economy. Now, if they're reducing the number of rate hikes, yeah, we're seeing some good data coming through, but we've seen corporate earnings over the last couple of weeks that have severely disappointed, except for 1 or 2 that have done really well, Facebook and Amazon and those guys. But for the most part, and okay, some of the banks also beating expectations, but still, you know, 80% less profit and so on. So not very strong corporate earnings season. So I think that perhaps fewer rate hikes for the year is necessarily a bullish indication. Maybe that's indication that they might do a bit of a turnaround and look at you know, easing monetary policy again, which I don't think is necessarily a good thing for the... I'm bearish. I'm generally bearish on everything, but I don't know if that's a good thing for the economy in general. You know?
Good thing for the economy or not? S&P yesterday did highlight the fact that more interest rate hikes for South Africa may not bode well for South African banks and credit risk. So can we absorb these interest rate hikes that we could possibly see in South Africa?
So when the SARB talks about this, they say they have not neutralized interest rates to a level that is consistent with what history would have suggested. In other words, they're still an accommodative monetary policy. And we're finding a situation where we have a very independent central bank that has a sole focus on inflation. I appreciate what Standard & Poor's is saying, but if you look at the performance of bank shares, they began to price in bad news, including a downgrade, including more tightening. You look at the balance sheets of some of these banks are strong. Yes, the household surprisingly remains resilient, despite, you know, the negative outcomes that we were talking about. So on a balance of probabilities, the SARB may sound a little hawkish. They may even do 1 more rate hike if inflation surprises on the upside. The 6.3 pullback in inflation was just statistical base effects. It could still peak around 8% by year end, which will leave the central bank very uncomfortable. I won't be surprised if they hike, but in sight of next year, 2017, you might even see an aggressive interest rate cutting cycle as opposed to just remaining at high levels of interest rates.
Petri, you've seen the equity markets, like we said, certainly a very high correlation between the oil price and what equity markets are doing. And now we've been seeing, the oil price certainly making a comeback. Platinum holding still above that 1,000 mark. Gold seems to be doing well. Iron ore. So is this the end? Can we now safely say that, for us, as South Africa or emerging markets who are so reliant on resources, we in the clear now?
I'm not brave enough to make that call. No, I think in the short term, yes. The surge in commodity prices is helping our equity market, but I don't see how that's necessarily changing the fundamental picture that is South African economy. We are seeing many resource companies consolidate, sell off assets, that kind of thing. So yes, they will return to profitability and things will be good, but will it change the course of the entire ship? I'm not 100% sure. This could be the bottom. This could be the turn in the equity market, or this could be the turn in the commodities market, which could then lend to another 7 years of plenty in terms of bull market. But whether it is or not, I don't know, to be very honest. I think that we've seen a lot of commodity prices rise on speculation. Iron ore prices, for example, is one from $35 to $70 per ton, which is fantastic, and people are extremely getting very bullish on iron ore prices and commodities at large. But when you consider that you traded an entire year's supply of iron ore contracts in one day, which was a tremendous rally for iron ore, you have to wonder, is this not maybe just speculating? Because they're trading iron ore in the hope that iron ore stockpiles will be rebuilt, which hasn't happened yet. But traders and speculators and funds and so on are taking positions in iron ore in anticipation for something that hasn't yet happened. And we see similar things happening across other commodities as well. Oil, for example, has also run incredibly hard, but at the end of the day, even if they freeze output, you've still got Iranian oil that's going to come to market. You don't necessarily have a massive uptick in demand. So is this a relief rally, or is this the bottom? I, at this stage, don't know.
What about that C factor, China? Everybody talks that culprit that's been responsible for, we've seen equity markets in the red. We've seen some positive numbers come out of China of late, but then you've got the likes of the billionaire businessman Carl Icahn say, earnings for Apple have come out. We've seen pressure in the Chinese markets. I'm actually not going to be holding my position on Apple anymore. So your position on China then?
Strong export growth that has been seen, but the GDP number, the government talks about 7%, but electricity production, if you look at that number, suggests that, in fact, GDP is potentially below 5%. Not even the 6.9 that we're talking about from the official side is potentially 5%. But that ought to be expected, and I do think that markets are now beginning to simulate that, to say that you grow 10% for a good decade, you ought to slow. You reach middle income level, that suggests that ordinarily there needs to be a slowdown that happens for economies that run to about 8,000 per capita GDP growth, which is where China is at. So my position of it is that it's slowing, and it will remain structurally like that. But we may see cyclical rallies in commodities, as we have seen, because while they have slowed, they're doing other things, including the new Silk Road that could create new demand for commodities. India, for example, is growing at 7%. In fact, in the oil market, you'll see that although its consumption of petroleum is still half that of China, it has increased somewhat its demand for petroleum. That's why oil is supported at these levels. So cyclical rally in commodities is likely within a structural bear market.
I've got a minute left or less than that, so very short answer, very difficult one, I think. Emerging markets, Petri, I'll start with you. Back in favor at the moment? For
now, yes. I think for now we probably see a rally, this resource rally continue in the short term. Whether or not it's going to make it into months from now, I'm not sure, but in the next couple of weeks, couple of months, definitely yes.
Short term, back in favor, says Petri. Long.
Price-earning ratios, valuations, underpins your potential performance going forward. After such a beating on currencies, even with this relative growth that is now moderated, they look very interesting. They're cheap relative to developed market, relative to their own histories in terms of normal valuation matrices. I look at emerging market in a favorable light now.
Okay, gentlemen, thank you so much for coming in and giving us the outlook for emerging markets and, of course, making sense of some of the economic data that's come out and how to interpret it. A very big thank you to Lesiba Mothata, Chief Economist at Investment Solutions, Petri, Redelinghuys, trader at Inkunzi Investments.